We see, however, aviation stakeholders should start investing to de-risk advanced technologies to help bring these policies down, and also understand how these policies are working together to drive decarbonisation and try and decrease the cost burden as all these policies interlink. So ETS is by far the most significant scheme in the near term. It's also the most effective scheme, and other nations are taking note, hence why we're seeing others starting pilot schemes and gradually maturing their own versions of ETS policies. We believe you need to advocate for this and approach on the front foot and address any shortcomings with a progressive attitude to try and decarbonise the sector, because it will drive the required investment needed cross-sector, including in aviation, to bring costs down, decarbonise the economies, and it will breed resilience with active participation. Not that there's a choice of ETS, of course. So we expect ETS costs to peak around 2030 to 2035 before reducing out to 2050 as SAP uplift increases and abatement starts to take over to reduce your EUAs through the ETS. Corsair is currently very low cost, as we talked about. However, out to 2050, we expect traffic to more than double, but well beyond the 2019 baseline that's been set, as well as higher cost, high credibility offsets to come online. So we'll start to become more material. The current scope of Corsair is out to 2035, but of course we probably expect that to be extended if it is successful. In terms of the voluntary market, in 2050, you can see there's the red there. This is assuming that nations and airlines are committed to their net zero targets. Hence, the cost will be high if we revert back to the roadmap that I talked about earlier in terms of net zero. So clearly, it is discretionary, and therefore the actual risk exposure is low. However, we should say in terms of the action takeaway, the participation in these markets creates resilience and will reduce exposure in the long term. The legal risks has been in high profile in recent times. Throughout the transition, as organizations state claims and comply with policies, they may be challenged as further transparency and oversight is brought into the market as it matures. So there is risk of fines and litigation if actors are not careful and diligent in those areas. So now looking at the BAU risks, the physical risk is clearly on the horizon in terms of climate change. Temperatures and extreme weather are limiting operations and may limit operations, will limit operations in certain areas, and increase operational costs through harsh conditions. I don't need to go over the risks related to the continuation of dependence on fossil fuels, as we're also living and breathing that right now. One note on engine reliability, which I mentioned earlier. The industry is currently experiencing really high costs and lots of disruption to services, especially in narrow body operations for new technology, but also wide body Trent 1000s and Trent 10s. The fixes are coming through. There's no potential action apart from mitigating through diverse portfolios. But these are material costs. There has been statements about how these have wiped out efficiency benefits and some. So yeah, it's a serious issue and definitely overshadows the costs that we're seeing from compliance at the moment. Need to talk about economic demand drivers, as they are the core determinant for traffic and fares. So forecasting scenarios related to the outlook for key growth markets such as India and China, for example, is really important to understand your future business risk. I would say more so than discrete and level cost inputs from regulation.